I'm sure you will not meet many telco CEOs who actually worked in investment banking. Aziz has worked on the buy side and on the sell side. He's worked in Paris, in London, and in Qatar. He has been on the board of Ooredoo for more than 10 years and is managing the group for almost 2 years now. Those who are following our quarterly calls or have joined the recent Qatar Exchange HSBC London conference will be very familiar with him. Aziz also conducted many roadshows for the state of Qatar in his role as an advisor to the Ministry of Finance. So, the floor is yours, Aziz.
Good morning, good afternoon, everyone. Welcome to our Capital Markets Day. We're very happy to receive you here, and hopefully by the end of today, you'll have a better view of what is our strategy, what, why, and how we're doing things. We're going to start with our point of departure. Who is Ooredoo? Where we are today? What is our strategy and our path forward? And lastly, I will finish on value crystallization. So, most of you know us very well. But who is Ooredoo for those who don't know? We're a telecom operator which operates in 10 countries. 9 operations are consolidated. Out of 6 are ranked number 1 and number 2 in the respective markets. One operation, as you may be aware, Indonesia, which is one of our largest, today is a joint control vehicle. So operationally, we still have a lot of influence and overture over that operation, but from a financial standpoint, it's no more consolidated in our accounts. If you look to the left of the slide, you'll see we cover nearly 500 million people in our footprint and have a total subscriber base of 153 million people if we include Indonesia. If we exclude Indonesia, mostly in the Middle East and North Africa region, we have 53 million subscribers. In our footprints, there are around 109 households. We provide, as you'll see in the next slide, in most of our markets, if not all, fixed or mobile broadband. Today, we only cover around 2.5 million people out of 109 households in terms of broadband. That will provide a significant opportunity going forward. If we look at the breakdown of our markets, as I mentioned before, we're number 1 in 3 markets, Qatar, Iraq, and Tunisia. We're number 2 in another 3 markets, Oman, Palestine, and Maldives. In Indonesia, we're the second operator as well. And in Kuwait, Algeria, we're number 3. In Myanmar, we're number 4. As you can see, we're a mobile operator across all our footprint. We provide fixed wireless or mobile wireless in all of our footprint. If you look to the right side, it's our blended return from capex intensity per inhabitant versus ARPU. What you see is Qatar is a significant outlier. It is capex intensive, but it also has a very high annualized ARPU. In the middle, Oman, Maldives, and Kuwait are medium ARPU countries with medium capex density. And of course, at the bottom, you have low ARPU countries with low capex density. How does our revenue, our EBITDA, capex, and free cash flows break out through our operation? What comes out of this slide is the predominance of Qatar. Qatar represents 34% of our revenues and close to 44% of our free cash flows. If you add Iraq, we're at 50% of our total revenue base and 60% of our total free cash flow base. So excluding Indonesia, 2 operations, Qatar and Iraq, represents nearly 50% of our revenue and 60% of our free cash flow base, as well as all the other operations representing the other 50%. In this slide, we're going to cover where does Ooredoo fit in terms of overall performance in the telecom universe. It's a very heavy slide. Hopefully, I'll try to make it clear and simple. At the upper part of the slide, what you'll see is the global top 20 telcos. At the bottom part is our regional peers. And we've given our score for different metrics versus the top 60 telcos in the world. What you see in terms of revenue growth from 2020 to 2021, we ranked 39 out of 60, with an annualized growth of 3.6%. In terms of EBITDA growth, we actually ranked 22 out of 60 with 8.1% growth. In terms of free cash flow growth, we're actually in the top quartile at a position of 15 versus the top 60 with a 20% year-on-year growth of free cash. Here, how does that translate to our shareholders? Well, in terms of enterprise value, we rank 47 with an enterprise value of around $12 billion. In terms of total shareholder return, actually, we're not even in the top decile, we're number 3 with 36% total shareholder return. That includes dividend reinvested out of the whole telco universe. Now, the last slide is the most important, is relative to all that performance, and you've seen we're consistently in the upper half, and in key metrics like profitability or free cash flow, we're actually in the top quartile. We unfortunately are only valued at a 4.7 times multiple in terms of EV to EBITDA. That puts us at a position of 49 out of 60. Therefore, we believe that as a telecom operation, we're significantly undervalued compared to our relative performance to our peers. This is also expressed by the slides, but there's a glimmer of hope when I look at this slide. What we noticed is that for 2021, when we embarked in our transformational journey, our shareholders actually didn't give us much credit for our journey, and our share price remained relatively flat and underperformed our peers and the general MSCI Telecoms Index for the emerging market. What we've noticed in the last 12 months, and especially in the last 6 months, is a significant rally in our shares. We're very happy about this performance, and for us, it's an indication that shareholders are now starting to believe that our journey is a consistent one and is not just a one-off for 1 year. Another part which is extremely close to our heart, but also to our shareholders, is where are we in terms of our ESG journey. It's a new journey for us. But even if it's a new journey, we're actually already in the top quartile. We're above average in nearly all metrics. You see here the different pillars of the ESG rating. In terms of environment, social capital, human capital, and business innovation, we're above the peer group. The peer group actually consists of the top 15 global telcos and our 10 regional peers. So it's a quite stringent peer group. The only metric where we need to improve, and we're going to work very hard, is in terms of leadership and governance. Anyway, we will dive deeper into our ESG performance with the presentation of our CFO, Abdullah Zaman, later down the presentation. Now, maybe, what is our strategy? How have we generated that growth, these returns, this outperformance over the past year and a half, and how are we going to sustain it going forward? First, maybe let's take stock of where we stand as an industry in general. Here you have a very simple chart. I'm sure you're all very familiar with it. It's the average return on equity and return on investment capital for telecoms in general relative to other industries. What comes out is telecoms are utility. We're actually very close to electric utilities, and in a way, industries such as oil refinery, grocery stores have much higher return profile. But this is our starting point. Now, this is around what we've shaped our strategy and how can we beat our peer group. So where do we stand as a telco in this universe? There are basically 3 big models in terms of telcos. There's what is called Horizon 1. It's a very basic, extremely efficient bit pipe. There is what we call a smart telco. It's a Horizon 1 player, very efficient bit pipe, where we've overlaid above it smart analytics and adjacency revenues, especially from VAS and digital services. With one caveat, limited investment in the adjacency and digital services. This is called a smart telco. The last is the Horizon 3, a multi-core, and we've seen a number of operators going down that road, which is investing actually in digital asset, in digital content, digital media, which is a business model we don't believe fits our DNA and our footprint. So Ooredoo wants to be strongly centered around being a smart telco. As I mean, a very efficient bit pipe with overlaid revenue streams. How do we get there? Well, there's 5 core pillars we've been following as a mantra for the past year and a half to our portfolio. One is creating a value-focused portfolio that's looking at our asset base and how can we optimize it. Two is strengthening the core, basically becoming an excellent Horizon 1 player. This was going to be covered later on by Saim. Three, it's evolving our core. How do we become a smart telco? This is going to be covered by Renee. We can't do any of this without the talent, and talent today is a big challenge in our universe. We're facing an extremely competitive environment. This is going to be covered by Fatima. And finally, the only differentiation we have, we basically sell minutes and data. The only differentiation we have to our customer is the quality of our services to our client and how we treat them. It's a fundamental pillar in our DNA today, and this is going to be covered by Bilal. So how do we go about for crystallizing value through our portfolio? There are three big pillars which we've been focusing on for the last 18 months, and for those that have attended quarterly calls, some of this will sound familiar. Hopefully I'll give you a bit more detail. One is our telco operation. How do we consolidate our position in each and every given market? Number two, what do we do with our passive assets, mainly towers? How do we maximize the value from these assets, which are currently unvalued by you, rightfully so, in our balance sheet? And how do we capitalize on a strong opportunity on some of our core assets, which are data centers? The first is telecom operation. Through a very disciplined and rigorous methodology, we want to aspire to be number one and number two in any given market. It's very important for us to understand what is the path to getting, for the three operations where we were number three, how to get to a number two position. We are looking at organic and inorganic manners. The number one example is the merger we've closed, and this, you've heard us talk about it a lot, in Indonesia, where we merged Indosat, which was a challenge number two at 16% revenue market share, with the number four player. Vikram, who's going to join us later, is going to walk you through the value creation that merger has created. I can give you a few highlights. We're now a very strong number two. We are ahead of the synergy plan, and we now went up from 60 million to 90 million subscribers in Indonesia alone. The second part is looking, again, in a very disciplined manner to our portfolio. We've announced very recently the exit, our intended exit out of Myanmar. It's been a very challenging operation for us, depending on the market itself, which has been extremely competitive with four players. We were the fourth player. We didn't see a path to get to number three or two, but also recently, unfortunately, it's been extremely challenging economically and politically. Therefore, we were happy to announce that we've signed the sale of Ooredoo Myanmar to Nine Communication. We believe this is a value accretive transaction. If you remember, in 2021, we had taken a total write-off for our operation of Myanmar. We've managed to crystallize a value of $566 million, which compares very favorably to previous transaction in Myanmar, especially the sale of one of our competitors. This should yield $162 million back to the group. We're hoping, and this is a very aggressive timeline, to close this transaction by the end of this year. This is our stated target. I'm going to be honest, there's a chance that that slips into next year. Number two, towers. And you've heard me talk a bit about towers. What are we doing in towers and why are we doing in towers? We're stating that we want to carve out as an arm's length business our tower business. And I'll walk you through why. There's some very fundamental reasons. As of today, if you look at our portfolio of towers, they're passive assets, 92% or plus, we're the only tenant on them. Multi-tenancy is a very efficient way of reducing the operating cost of these assets and also generating yield by non-yielding assets. Also, by separating the towers from our normal business, we can optimize the capital structure. As you know, a tower business is an annuity business. It is not the same type of business as a pure telco operator. Lastly, by doing this exercise, and it's been a very tedious exercise for the last 18 months, today we can tell you in each opco per every site what is the exact cost, CapEx, fixed and variable operating cost of each tower. this is valuable data for us. This is what is going to allow us to actually monetize our network better for each and every tower. What do I mean when I say a tower? Well, this is the whole structure of a tower. When we're carving out the tower, we're only carving out the gray areas in the chart. That means the metal structure itself, the foundation, the least attached to the foundation, the shelter, cooling unit, and the power generation unit. All the rest, which is in red and blue, will be kept by Ooredoo, the active equipment, and by further tenants. How does our tower portfolio look? We actually have the biggest single tower portfolio in the MENA region, with over 20,000 towers. It is split between the 6 opcos. What you'll see is all countries, except Qatar, have at least 3 operators, if not 4 in the case of Iraq. This gives us quite an opportunity for multi-tenancy. Also, what you'll see is an even split between the different countries. You have 3 countries, Qatar, Oman, Kuwait, which probably offer slightly less growth opportunities than the other 3 countries, but extremely stable FX and stable income economic environment, versus the other 3 countries provide a much higher growth potential. We believe that it's a fundamentally extremely attractive portfolio. As mentioned, for the last 18 months, we've done a scrupulous work on our tower portfolio. How is this tower portfolio breaking up? Because towers in themselves have different value. We have, as you see, 41% of our portfolio are actually ground-based towers. These are the towers, typical type of towers that hold the highest value because of the robust size and the capacity they're able to hold in terms of equipment. 59% are rooftop, but if you pay attention, actually 55% of the rooftop sites are rooftop towers. So they're basically ground-based towers built at the top of a building. So these carry usually the same value as ground-based towers. That means we have close to a high tenancy portfolio of over 75%. Also, what's important, like in any real estate play, is where are these towers situated? Again, what you'll notice is over 75% of our towers are in urban, suburban, or dense urban areas. Last but not least, as maybe a bit counterintuitive, actually the metric I focus here is close to 40% of our towers are off-grid or poor grid. Why is this important? Because these are towers which have power generation units, usually diesel, and if you bring multi-tenancy, you're able to mutualize the cost of that power generation unit, of the fuel, of the logistics for the fuel between different tenants, and that's a major lever to gain operation efficiencies as a telco. Also, once we've carved out the towers, we generate operational efficiencies, but we're creating a standalone business with or a significant minority shareholder, multiple minority shareholder, or actually we can become the minority shareholder. But this is also a value arbitrage for you. And as mentioned, and you may be seen in the press, we're looking at different strategic options. We haven't finalized, but this is the value arbitrage today. What you see, as I remind you, Ooredoo is a telco, trades at 4.7 times EV to EBITDA. When towers on average trade at close to 22 times. If you look at regional transaction, the last transaction was at 15 times. That creates a huge opportunity for value crystallization, whether we sell them or retain them. By bringing this business as a standalone business, it will allow you, investor, to see what is the crystallized value of that business separate from the core telco. Data centers is a similar story, but slightly different. This is the macro picture. It won't be a surprise. Data has been growing exponentially across the world. COVID has been a huge catalyst, but not only. We've seen the digitalization of governments, of enterprises, continuous move to cloud. Businesses going from on-prem to cloud service. Consumers using more and more data, higher quality data for video streaming, gaming, all of this. Businesses requiring data analytics, AI, to a level today which is close to impossible to do on-prem. Has to be done in the cloud again. and of course a proliferation of devices. The first example is 5G. This is driving huge data growth, and we have to warehouse this data. This is called data centers. As a telecom provider, historically, we've always had data centers. This was for our own use. This is where our core resides. If you look at the chart on the right, this is the interesting opportunity. Developed countries have a huge amount of data capacity, while the Middle East today is still lagging behind and is now going through that digitalization curve. So where does that put us as Ooredoo, and why do we believe that data centers are a compelling opportunity for us? If you look from 2021 to 2025 on the chart on the right, it is forecasted that data center capacity will quadruple in our market. One interesting piece of data, if you look at 2022 today, out of 46 megawatts in our total footprint, Ooredoo actually represents 66% of that total capacity. We are already a market leader in most, if not all, the markets we operate in terms of data center. This is our first competitive advantage. Another significant competitor advantage is the strong barriers to entry. It is very hard for multinational companies, for foreign companies to come and establish land ownership in the countries we operate. As a telecom operator, we actually own land and are allowed to own land. And we believe this is probably one of the strongest barriers to entry. The huge catalyst of growth is also driven by the stringent regulation in our markets. Even if there's cloudification in our market, all of our markets have what we call data residency. The data is allowed to sit in a cloud as long as that cloud is housed within the borders of that country. Again, this is an extremely compelling argument. It avoids that our captive markets migrate to neighboring markets. The last but not least, a data center is a warehouse, but it needs to be connected. It needs connectivity, and that's the core of our business. As Ooredoo, we own not only the land-based connectivity, but we also have an extensive network of landing station and undersea cable to link all these data centers together. So what is the opportunity and how are we going to tackle it? We're going to carve out our data center business. This is a business where we're very clear for the foreseeable future we want to own control. We want to capitalize on that growth. But it needs to be a separate business for a few reasons. One, a bit like towers, it's a different business. It's an annuity business as well. It has a different capital structure than a pure telco. Second of all, it's extremely important, especially for hyperscalers, that we become carrier neutral. It's very hard to become carrier neutral if that business is captive within the telco opco. Last but not least, we also believe that down the line, this will provide probably the opportunity of crystallizing significant value. So what do we intend to do? Well, in the medium term, we intend to grow our data center capacity by 4x. We intend to do that by investing over $1 billion, and we're hoping to start that journey of separating the data business as a standalone business unit by the end of 2023. Again, just a bit of few metrics and to show what we believe today is unrealized value on our balance sheet. We today already own 30 megawatts of capacity in our market. Here, numbers you're probably extremely familiar. What you see is that data centers in general at the low end trade at a 15x multiple all the way to a 40x multiple. For us, that represents a lot of captive value which is not reflected in the sum of the parts. Thank you very much, and now I hand over.